Jonathan Camarda with your mid-year market update 2024. So let's get started right now from the macro to the micro. From a macro standpoint, jobs numbers, again, recent influx, decent numbers, but of course the revisions from the prior months, as usual, have been lower, along with higher unemployment rates, which is creating a dovish sound for those when we look at rate cuts coming up. In fact, when you look really at the employment picture we've been talking about, there's been a softening for a while, especially in the upper echelon jobs. And so again, I keep my ear to the grindstone, so to speak, and communication with M7 MBAs, CFAs, upper graduate level type folks, and the jobs they expected when they started their journey, by the time they get out, not what they expected. That's generally, again, you start to see that deceleration. And again, we shall see. But now we have projections of a 65% probability of a rate cut in September, 70% that we're going to have two for the year, one coming after the election. So let's get started with where the dollar has been, right? The dollar, right? It's been hot, it's been cold. This year, a little bit of lukewarm. 2022, great year with the Fed hiking rates, market dived, right, and just took a crash landing. Last year, the dollar was weak coming out of the gate, stayed weak as the Fed slowed down, and the market, of course, had a great rebound year. This year, market's up nicely, but the dollar's been kind of drifting sideways, only slightly up, underperforming the euro slightly versus the British pound, outperforming the yen and the Canadian dollar, but at the same time been really a non-factor. Now, as we get to fixed income, right, we start to look at that inverted yield curve. Well, started to look at. We've been looking at it, for the last couple of years. Again, this is a long time. Again, that's again for you new gamers there. The short end of the yield curve yielding more than the long end. Typically, that's not the case. It's the reverse. But again, when we're looking at 2 years versus 5 and 10 years on the yield difference, plus 30 basis points. So guess where in our conservative strategies like active capital preservation, we've been hanging out on that short end of the branch. You have less interest rate volatility and a higher yield. What's the figure out there? And again, as far as our fixed income components, beyond 7 year on the U.S. Treasuries, negative for the year when you go out beyond 7 years, and even the corporates and the such been choppy for fixed income. So mortgage-backed securities, preferred stocks, floating rates, some cash-type vehicles with higher yields, what we've been taking advantage of if you look again in strategies like active capital preservation in that situation. Again, that hasn't changed yet. We shall see. We head into a recession, things slow down. The long end of the curve should become more attractive, and we will, of course, be vigilant on that end. Now, as we roll into commodities, right, we've had silver, copper doing pretty well. Gold, slightly above double digits as it's slowed down recently. Good year for commodities. But what we're looking at on the inflation front, okay, is the sugar versus gold ratio. And sugar's been pretty resilient to the upside versus gold, which has an inflationary tinge to it. Not hyper, but just to keep, again, that disinflation picture not so clear, focused guarantee. Again, still a softening overall with the expectations aforementioned that I just spoke about with the probabilities of the Fed, cutting rates September and later in the year. Now, as we get onto the front as far as globally, U.S. has been one of the more attractive neighborhoods. I think Turkey and Peru, don't quote me, have had better years. Europe, double digits, not too bad. And in Asia, kind of lukewarm. Taiwan and Japan, great job. Japan getting off the deck, right? And Japan's doing pretty well. In fact, on the earnings globally, on forecast and as such, right up there with the U.S. on what we've seen on earnings growth. Now, as we look at from a factor standpoint, it's been no surprise. Large cap growth and momentum been the most attractive places to reside. Small caps, pretty much, nothing to talk about. Mid caps as well, not as attractive as large cap stocks. So that's where we've been residing until further notice. Again, it's been pretty overt. Now, when we look at the S&P 500, right, you guys have heard of Five Guys burgers? Well, when you get to about my age, got to eat a little bit more chicken, all right? But we're talking about this market being the five-man market. We're talking about Microsoft, Meta, Amazon, Alphabet, and NVIDIA, and not necessarily in that order. As far as responsible for this year's S&P 500 returns, drum roll please, over just about 69% attributed to those five, the five-man group, if you will, NVIDIA being over 30%. About $3.7 trillion Increase in market cap across those companies year to date. Trillion with a T. All right. Again, these are approximate numbers memorized, so don't quote me right down to the penny, please. All right. So again, in summary, we've been still pretty opportunistically aggressive given that. Now, as we get to the seasonal patterns, June, unseasonably strong, right? Usually June's a little weak. This year, like we talked about, pre-election year stayed strong. Usually the first 13 days of July, market moves up and to the right. We've seen that. So you'll notice your allocations, we're staying true to form there. Generally, when you get to the latter portion of July into August is when we see our weakness, like last year, although election years can be a little bit more docile. 2020, the last election year, we did see that 8.5% approximately pull back in the fall before the election after a good, strong summer. So again, we're watching for that as well. We got our foot somewhere near that brake pedal for you F1 fans out there and you NASCAR fans. Okay, we're not going to delineate between the two of those on this podcast here. All right, so what we're looking at again is opportunistically still deployed. If your situations again call for idiosyncratic changes based upon risk tolerance, cash flow, life circumstances, talk to your personal wealth advisors, as my own individual clients as well. Stay frosty. We'll stay vigilant. You know how it goes. Till next time.